Imagine waking up to find your bank account frozen, your savings worthless, and your country on the brink of economic collapse. This is untamed dystopian movie plot. It's a very real possibility as the global debt crisis looms larger than ever before. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're diving deep into the global debt crisis of 2025, a financial time bomb that is ticking louder with each passing day. Global debt isn't a new concept, but the scale and growth rate we're seeing in the aftermath of COVID-19 is truly unprecedented. To put it in perspective, the worldwide debt-to-GDP ratio remains at historic highs, signaling that these massive debt burdens are not just temporary blips, but structural issues deeply embedded in our economic systems. Let's start by clearly defining what we mean by global debt. It's not just governments borrowing money. It includes both public debt, what governments owe, and private debt, what households and corporations have borrowed. According to the International Monetary Fund's latest projections for 2025, global debt now stands at a staggering 235% of world GDP. In simpler terms, for every single dollar of goods and services produced worldwide, there's $2.35 of debt hanging over our heads. Public debt is the primary culprit here, now making up roughly 93% of GDP. An all-time record. This surge has been driven by governments borrowing heavily since 2022 to combat the economic fallout of the pandemic. While private debt has stabilized or even slightly decreased in some economies, it's the ballooning public debt that's keeping economists up at night. Looking at major economies, the United States is approaching a debt level of 130% of its GDP. With federal deficits growing larger each year, China's situation is equally concerning, with heavy reliance on local government and corporate borrowing. In Europe, southern economies like Italy, Greece, and Spain remain heavily indebted, while their northern counterparts are grappling with skyrocketing interest payments on their existing debt. So, what's driving this massive buildup of debt? The COVID-19 pandemic is an obvious starting point. Governments worldwide spent trillions on health measures, economic stimulus packages, and social programs to keep their economies afloat. But that's just the tip of the iceberg. Rising interest rates have played a crucial role. The cost of servicing existing debt has soared, with governments now paying 2 to 3 times more to refinance their debt compared to 2020 levels. Aging populations in many advanced economies are accelerating pension and healthcare spending. Further straining public finances, geopolitical tensions haven't helped either. Conflicts, sanctions, and supply chain disruptions have forced increased spending on defense and subsidies. And let us not forget the ongoing energy transition. Decarbonizing our economies is an expensive endeavor that requires significant upfront public investment. Now, let's talk about the risks and threats this mountain of debt poses. First and foremost is the interest rate risk. We're facing what experts call a debt refinancing wall. Large volumes of government bonds are maturing soon, and they'll need to be refinanced at much higher rates. This could lead to a vicious cycle of ever-increasing debt servicing costs. For countries with weaker credit ratings, particularly in Africa and Latin America, the threat of default looms large. We could see a wave of sovereign defaults or IMF bailouts in the coming years. There's also the risk of crowding out. As governments borrow more, they absorb capital that private businesses need to grow and innovate, potentially stifling economic growth. Inflation presents another complex challenge. Some regions, like the United States and the UK, are grappling with inflationary pressures, while others risk deflation due to weak demand. This divergence makes coordinated global economic policy increasingly difficult. It's important to note that not all regions are affected equally by this debt crisis. Advanced economies, while carrying high debt loads, generally have better control over their situation. They can issue debt in their own currency and rely on investor trust. However, even they are feeling the pinch. OECD data shows that interest costs in these countries are at their highest levels since 2007. Emerging markets are in a more precarious position. Many borrow in foreign currencies like US dollars or euros, making them vulnerable to exchange rate fluctuations that can suddenly worsen their repayment burdens. The recent case of the United Kingdom serves as a stark reminder that even advanced economies are unimmune to investor pressure. Borrowing costs surged after global bond yields rose, sending shockwaves through the British economy. So, what can be done to address this looming crisis? Policymakers have several options, each with its own set of challenges. Fiscal tightening, cutting, unnecessary spending, tackling subsidies, and raising taxes is one approach. But it risks political backlash and economic slowdown. Debt restructuring, which involves negotiating with creditors to extend maturities or even partially forgive debt for the poorest nations, is another possibility. Some advocate for growth-first strategies, focusing on investments in green infrastructure, digital transformation, and education to raise long-term GDP growth. Central banks, meanwhile, are walking a tightrope, trying to control inflation without choking off growth through excessively high interest rates. But what happens if these measures fail and debt truly becomes unsustainable? The consequences could be severe. We could see a wave of sovereign defaults, with nations unable to roll over their debt, potentially sparking widespread financial crises. Currency crises could follow, with weakening local currencies triggering hyperinflation or capital flight. The banking sector wouldn't be spared either. If banks hold too much government debt, instability could quickly spread throughout the entire financial system. And let's not forget the human cost. Austerity measures, tax hikes, and reduced welfare spending could lead to social unrest and political instability. The lessons from Greece's debt crisis in the 2010s remain painfully relevant. To wrap up, it's clear that global debt is at record levels, and the risks are very real. How policymakers respond in the coming months and years will determine whether this crisis deepens or if we can find a path to stability. But it's not just a problem for governments and economists. This affects all of us. As we conclude, I encourage you to reflect on how this sovereign debt crisis might impact your own life. How could it affect your investments, the job market in your area, or even the taxes you'll pay in the future? These are questions we all need to consider as we navigate these uncertain economic waters. Now, I want to hear from you. Which risk concerns you most, rising interest rates, the possibility of sovereign defaults, or the potential for social unrest? Share your thoughts in the comments below, and let's get a discussion going. And don't forget to hit that subscribe button for more in-depth analysis of global economics. Until next time, this is Economy Unpacked Daily, helping you make sense of the complex world of finance.